Welcome to Oxford Analytica's weekly video briefing. I'm Stephanie Hare, Senior Analyst for Western Europe, and I'm in conversation today with Vanessa Rossi, one of our beloved contributors, and who will be joining us at this year's Global Horizons Conference in September here at Christchurch, Oxford University. Vanessa, welcome.
Thank you.
Great to see you as ever. And we're here to discuss the raft of data that's come out about European economic performance. And what I'd like to put to you is the mood changing? Are there reasons to be cheerful?
I think we've at least put some of the gloom behind us. I think getting too optimistic may be rather ahead of the game. But let's take them one at a time. I think the most obviously good news has been the UK's figures out today. Of course, it's one of the first to report in Europe, so we don't yet know what happened in Q2 for some of the other major economies. But for the UK, the 0.6% may have somehow disappointed markets, which really thought that George Osborne was delivering them even better. But frankly, I think it's a pretty good performance in view of the continuing problems in the Eurozone. Certainly, there's been signs of how to do growth in this performance. For example, getting the housing market motoring again is extremely helpful, not just in its own right, but because it also tends to generate more positive consumer sentiment and indeed spending. One of the weakest elements of spending for some time has been home furnishings and so forth because of the lackluster performance of housing. So if this is moving again, just as you've seen in the United States, it helps to buoy up all these other sectors of domestic demand. So I think we know that that's on track, and very helpful to have some of the easy money policies pumped in to help push that forward. And if it's enough to prod on the UK economy to better things in other directions, then it's probably money well spent. There's been a lot of caveats about whether George Osborne should have put so much money out to help first-time buyers and so forth. But I think if this does the job of achieving that lift off into growth that's so much wanted, then it will be seen with hindsight as perhaps not such a bad deal after all, compared to potentially spending money in other areas that may not have been effective or would have created long-term liabilities that could have been even worse than these. So I think this is clearly quite good news. And if we look at it on the yearly basis, in fact, if you continue to roll on at 0.6, it does mean that the annualized rate is actually somewhere around 2.5%, which is pretty good. Now, the year-on-year at the moment is a little depressed because of the previously poor performances, but if we think of this as an ongoing process, I think we'd be really pretty pleased if we could get back to UK growth of over 2%. So let's hope this continues. It's a very broad-based improvement too, so we're not too reliant on any one spot, although certainly, as I said, the housing market and consumers are helping out here. Now, if we turn to continental Europe, there's a range of news which suggests that at least the problem's bottoming out. Continental Europe has clearly been in recession and has been struggling to move out of that without the impetus from the export side that it tends to need. The consumer demand has been depressed and weak, in some cases because of cyclical buying in car markets, in some cases because of still increasing unemployment. And this mix of problems doesn't go away too easily, but we seem to have at least seen the worst of it, and I think that, while not entirely positive, is at least putting the worst of the gloom behind you. There's hopes that building on that, during the second half of this year, you could see a very modest return to growth. This is very much as we penciled in when we were reviewing the prospects for this year with the Oxford Analytica briefings, and indeed the recent ones looking ahead to the next part of this year. I think we will see steadying out and very slight improvements, particularly of course coming through, I would expect, in Germany, but possibly with a couple of other economies coming along behind that. I think France is very hopeful that they can achieve more positive figures. What I fear with this, though, is that it's going to be rather like 2009, when continental Europe came out with more positive numbers for the second quarter, claiming that it was out of recession and turning the corner, when actually most of that growth at that time was generated by falling imports, which was not terribly good growth, good quality growth, if you see what I mean. But even this will be enough perhaps to change the mood music. And if we think about building on it, the greater hope is that maybe 2014 could turn into something a little bit more like 2010, when we saw a very sharp move up in growth, partly because the rest of the world was growing. So coming back to the rest of the world as the motor, we know that the US has got a fairly solid recovery, I think, in spite of these endpoint problems still popping out like Detroit. You've got a pretty well consolidated recovery in housing and consumer spending, as well as reasonable performance in trade. If we look at the Asian side, while growth may not be quite as fast as it was a few years ago, it's still pretty good. Remember, China's growth, even if lower at 7.5, is still one of the highest growth rates we ever see in the world economy. And there's other Asian economies growing too. The South Korean figures came out at the same time as the UK's and show very good performance for the second quarter. So we can build on this, and I think that's where the hopes will turn, is that with a stronger world, slightly better export performance for the continental European economies, steadying out of the domestic problems, maybe we can see that little bit of uplift that so much is needed to improve confidence next year.
Now, this is a very sunny outlook, but one of the risks with such an outlook is that it could perhaps dampen the will to make the necessary reforms in some of the weaker European countries. And I say this because Ireland, of course, today announced that it's going to be putting a referendum to the people on October 4th to abolish the Senate, which is a rather unorthodox austerity measure, but it costs $20 million or 20 million euros to run every year, and they've decided it doesn't deliver value for money. So, this is one of the ways that Ireland is going to be looking at it. We know that, joking aside, that France is going to be planning pension reform in the autumn. Unions are already penciling in protests for that. So if we start to see growth returning to Europe, or even just a better mood and improved outlook, could we see people starting to backpedal on some of the reforms they need to do to restore competitiveness?
Well, I think that I put the best picture forward so far, and I think the UK's is fairly secure, and I think that if you take Europe on average, that's going to be okay-ish, and with particular economies such as Germany, probably the Scandinavians doing reasonably well. But I didn't mention that within this picture, that does not mean that all economies will be performing well and evenly, and I think there's still quite a lot of difficulties to face, as we know, with Portugal, Greece, Ireland, as you mentioned, although in some ways it's somewhat more secure than perhaps the Greek and Portuguese situation for the immediate problems of repayment of debt. We know that Ireland still has problems in the losses in the housing market, the losses in the banks, to still take on board. So there's a range of issues that have not been finalised. Even Spain and Italy are still not completely out of the woods, even if the bond markets are looking better, and there's hopes perhaps for a better performance for next year. So we're still going to have a very uneven economy, and it will take a lot more growth in the rest of Europe, and indeed growth in these reforms and changes in these economies to be able to kick them all back into performing well. So we're going to face this for a while, and of course there's, I think, more or less the expectation that some countries will need further bailout assistance. Greece and Portugal are likely to be high on that list. And although it may be postponed for the moment, perhaps rolled over into the next year because of German elections, because of changes in the European Commission, which will be very important next year in setting a whole new tone for the European Commission.
And the Parliament, of course.
And the Parliament votes as well. The only issue with the Parliament I bring up is that if the Irish are talking about this potential voting away of part of government because of the cost, one may have to think twice about some of the European institutions, and there's certainly there's been a long-standing debate, of course, even from before it was formed, as to quite what the role of the European Parliament is, the cost of it, whether it could be the same types of roles could be undertaken in a different or cheaper way. So I think nothing is free from scrutiny in the ongoing conditions. And I mean, David Cameron himself in the UK has been much emphasising the fact that he wants to get down the cost of government. So I think politicians are very aware that this is a time to be extremely careful when they're expecting
while
others to make
considering
sacrifices.
voting themselves a raise, of course, though, here in the UK Parliament.
Well, this is an awkward problem because this was actually due to an independent inquiry into the relativities of pay, which more or less came out in favour of there being increases for the members of Parliament, when clearly it's not the political time to do it. But the scrutiny was based on the very typical procedure for looking at comparability. And actually what the public's tended to forget is that this story coming out implies that those other pay scales with which members of Parliament are compared have gone up quite a lot. These are areas of local government, other kinds of administrations like the hospitals, schools and so forth, which have had more generous pay increases than the members of parliament. So I think sometimes that underlying message has got lost, and I think there needs to be some scrutiny in certain other areas as well. Perhaps some of those pay increases rather ran ahead of themselves in the better years.
One last question that I'd love to turn to you. We looked at some of the risks that could be happening within Europe to spoil our otherwise happy outlook. What about external risks? Anything that we need to be aware of from Asia, from the United States?
Well, I mean, there's clearly sort of ongoing difficulties with some areas of relations with the US, as we know. Although on the other side, they both seem surprisingly keen to press ahead with the free trade agreements, in spite of other squabbles. So I don't think there's really anything difficult to come out of that. Probably the worst factor from the economic performance is the ongoing efforts for banking sector reform, which take different types of forms in the US than Europe, but nevertheless everyone is pressing ahead. And as we all know, if you press too far too quickly, particularly on banks having to put more money aside for security, it means that you can have negative effects on the credit growth that you need to keep your economy moving. So I think there's a very fine balance there in how quickly you move forward, and we can see that in some cases there's been some backpedaling in terms of the speed with which these changes are implemented to take account of those problems. So we certainly hope that there's no great disturbance to that picture that comes out of the US, or indeed any European measures which are taken, until we see a very firm, sustained lift-off back into growth, when the banks can then begin to absorb those changes without impacting on the economy. If we turn to the rest of the world, I think Asia, in a sense, we've had some shocks. The slowdown in China, while many economists, many politicians have called for this for some time, rebalancing of the Chinese economy. Of course, they have to remember that the implications when you go into a transition of this kind may be somewhat negative for you in the interim, while there's a switch within the economy. And to some extent, that's what we've seen. Now, in spite of the fact that perhaps the growth then isn't as robust as it was a couple of years ago, I think we can probably still look forward in the next few years to pretty good export growth into growing areas, not only of China but the rest of Asia, the rest of the emerging market world, and that still will be where the growth story comes from in the future. So I think that's fine. Probably in terms of the more salient threats to Europe, we maybe have to think closer to home. Some of the events still unfolding, for example, around the Mediterranean, can still prove to be quite difficult, particularly in that it causes more refugee flows, potentially more problems in doing business in parts of the world, and possibly even tensions with some other parts of the world involved in that. So this is a particularly difficult period, I think, for European relations and European sort of side economic effects that can come through with this, in a way that the US is relatively immune. So we need to be a little careful about underestimating potential repercussions from those problems. But today's a pretty good day, so probably we want to finish on the upbeat note. It's nice to see a few growth figures back in that look fairly solid, and a few growth stories in the rest of Europe that we hopefully can see a little bit of build on in the second half.
Vanessa, Rossi, thank you very much.
Thank you.
And thank you for joining us. The outlook for Europe's economic forecast, sunny but with some clouds on the horizon, it sounds like. We will be covering this closely in the Oxford Analytica Daily Brief, and of course very intensely at the Oxford Analytica Global Horizons Conference in September. Please see our website for more details.